Hello viewers, good afternoon to you. At Nippon India Mutual Fund, we've always taken pride in connecting with our viewers on issues that are close to investors' hearts. So when we launched this NFO of Nippon India Flexicap, Passive Flexicap Fund of Funds, we received a lot of interest because this is an innovative idea that says that you can, create wealth from collective market wisdom. And there's also an idea about multi-cap investing, and allocation between large, mid and small cap has always been close to the hearts of our viewers. So we thought it was opportune to connect with you to explain the rationale behind this fund. Incidentally, the NFO is getting over in 3 days time on December 24th. So we wanted to make it quick as well. We have with us Ms. Hansi Mehrotra, who is a CFA and founder of a financial education website called the Money Hunts. She has more than 20 years of experience as a researcher and also a consultant. She incidentally led the Asia Pacific wealth management business at a global consulting firm. She also found it important that this idea, which is an innovative idea, be analyzed from investor perspective and its saliency for both retail and HNI investors, be brought out. Mr. Arun Sundareshan, who is the head of product at Nippon India Mutual Fund and also a CFA, kindly agreed, to explain the rationale of this scheme and the idea, and also take Hansi's questions. So let's begin, right? So we'll start with Arun explaining the thought behind this fund, its idea, its conceptualization, its construct, and then Hansi will proceed with her cross-examination. So over to you, Arun.
Thank you, Sandeep. Welcome, Hansi. Thank you for agreeing to understanding this product and bringing to your investors in detail. But before I get into the product details, at any point in time, you will appreciate that investors will have 3 questions. The first will be pertaining to markets. Is it a good time to invest in the market? Are markets expensive? Should I invest now or should I stagger it? That's number one. Second, if they end up getting perspectives about market and get convinced that yes, they need to go about investing, the second question comes to their mind is which type of fund or which category of fund should I invest into? Should I get into a large cap fund? Should I get into a small cap fund? What are the relative attractiveness, valuation and stuff like that? That's number 2. Now, once you decide on a particular category based on whatever analysis you do, the next question that investors have in their mind is, which fund do I choose within that? So every category of fund, there are 20, 30 different funds with different track record. Some of them have done very well in the long term. The recent performance may be an issue. Should I look at the past track record, the current portfolio, the market context? All these questions will be pertinent at any point in time. Now, for a moment, let me leave the market context part aside, unless Hansi has some questions on that. Let me try and address the second and the third question, which category of fund and how do we choose funds? Now, Sandeep mentioned about multi-cap investing. Multi-cap investing offers this distinct advantage of letting investors participate in different parts of the market. So sometimes, you've seen large caps do very well. Sometimes mid caps and small caps do very well. I'll give you some numbers here. For example, 2017, the calendar year, mid caps and small caps did very well. In fact, small caps gave 60% return, large caps gave about 30% return. The very next 2 years, that is 2018 and 2019, large caps ended up doing very well relative to mid caps and small caps, which actually gave negative returns. Now take this year, 2020. On hindsight, we know that it's been a horrible year. COVID, lockdown, unprecedented events. You would have expected, first of all, equities not to do well, but within equities, possibly large caps to do relatively well, but small caps this year have been the best performing asset class. So therefore, it's very difficult to time or preempt which asset class, rather which parts of the market is going to perform at various points in time. Therefore comes multi-cap funds which invest across market cap. You don't really have to break your head as to whether to invest into large cap, mid cap and small cap. You simply invest across the market cap and benefit from that. So that's clearly the advantage of multi-cap funds, which is the reason why it's very, very popular, is one of the largest categories in the mutual fund. So that answers the question number 2 as to which category of funds. Now, if you're convinced about this, the next question is, which fund do I go and invest into? Which multi-cap fund do I select? Now, there are a lot of different parameters you can look at to evaluate funds, but very obviously, and data also substantiates this, multi-cap category, particularly the canvas, the landscape in which they operate is huge. There are 3 decisions that the fund manager will have to make. Number 1, how much to allocate between large cap, mid cap and small cap. Second, how much to invest into various sectors. That is, should I invest more into financial, should I invest less into IT, etc. Third, which stocks to buy. Should I buy more of this stock, should I buy less of this stock, and so on and so forth. So basically, there are 3 dimensions, and depending on how fund managers make decisions on all 3 will mean the fund performance can be good or bad, a combination of which can be quite different at various points in time. So that is the challenge part. So on one side, you have the opportunity of multi-cap investing. On the second side, you have a big challenge in terms of selecting funds. And that is where comes our new offering, Nippon India Passive Flexicap Fund, a unique concept whereby we will take away the biases of individual fund manager in terms of allocating to different market caps, in terms of allocating to various sectors, in terms of actively picking up stock. Rather, go with the collective wisdom of the mutual fund industry, simply go by the average allocation towards large cap, mid cap and small cap, and go and make investment into large cap, mid cap and small cap parts of the market. So in a way, get both the passive nature comes from market investing. You're not making active calls on sector or stock, and you're also going by the industry collective wisdom, which is to make the large cap, mid cap and small cap allocation, you simply go by the fund manager, the collective wisdom of all the fund managers put together. So you get the best of passive and active at a low cost. So that is Nippon India Passive Flexicap Fund for you.
You want to explain the model a little more? How do you decide the allocation and stuff?
Yeah, I can do that.
So actually, I have a few questions before we do that. So why don't we just break it up a bit? Yeah.
Sure.
Can I sort of just? Thank you very much for a good summary, Arun. I agree with you on the various steps that investors have to take. So let me just clarify. I would add one more step though. So before you decide on equities, I guess you have to do a proper. People say the word asset allocation, but I believe in calling it wealth allocation, because you do have to take into account both your assets and your liabilities. Most people have their biggest part of their wealth tied up in real estate, which is their own house. So you have to take that into account. So wealth allocation is kind of more like a financial planning concept where you have to look at your overall wealth. So you have to have your emergency cash, your insurances, your gold, your house as your foundation. Then on top of that, you build pillars, which are long-term pillars for your long-term wealth building, which is, I believe, your own skill set as well as equities, by and large equities. Then on top of that, you can have sort of your fun money roof, which is your play money, either could be in your business, in ESOPs, or for the Robinhood investors, it could be your trading account. I want to clarify that this particular fund we're talking about, I think, should fit in this long-term pillars part of the portfolio, which means you allocate to equities and you let it sit for years, for decades. In fact, mine has been going for a good 20 years and I don't even check the account for 5 years at a time. So that's the first thing. This has relevance because we will talk about the next few steps. So once you've decided you want to invest in equities, my advice in all of my videos has been just get started. Don't think about it too much. Get started with a Nifty 50 ETF. In fact, I recommend the Nippon Nifty 50 ETF, just the cheapest way to get started and invest for the long term. Then as you sort of read more and understand about markets a bit more, then you can build on it. And the questions I have been getting from my friends and people who write in is, okay, so we've started with the Nifty, but then should we not also invest in mid and small cap? Surely, if we're investing for the long term, 20, 30 years at a time. And I agree. I think if you are investing for that long, then from a global point of view, my retirement portfolio is into Asian equities. From an Indian investor point of view, I think small and mid cap is that alpha kick, if you will, on that portfolio. But the problem with that is, how do you select funds? Which is I guess the big question, because there's 40 plus AMCs, they have hundreds of funds. So there's an article that I wrote that I again repeat, is there are 3 questions you need to ask. One is, can funds add value? 2, do they add value? And 3, how do I select them, or how do you select them? So you, meaning you yourself or your advisor, or a combination of the 2. And because, and this debate kind of keeps going on about the SPIVA report, the active, passive, and so on. I believe if you know how to do the research, you could go active in parts of your portfolio, but absolutely get started with the passive portfolio, which is why this fund looks interesting, I must say, because it takes the elements of both active and passive together. So as Arun said, the implementation is through ETFs, which is passive, but the allocation to large cap, mid cap, small cap is on a active or a quant basis, a preset algorithm basis. Okay, so now I would love to understand that algo a bit more. So can I hand back to you, Arun? Can you explain that a little bit more in detail so I can ask you about that?
Sure. So any multi-cap fund, what do? They invest across large cap, mid cap and small cap, right? Now each fund manager will have to decide how much they will put into the different parts of the market, and basis that allocation, the ultimate return and therefore the risk can vary. Some fund manager can choose to invest 50% in large cap and 50% in mid cap. Somebody else could have 65-70% in mid cap and the remaining into large cap. So this is a big variable which can ultimately result in difference in performance, right? Which is why we have noticed historically the difference between the performance of one fund and another fund keeps on changing. In fact, what we have noticed is that a particular fund does very well in a given point in time, in 1 year for example. The very next year, because the market context changes or its calls have gone wrong, the same fund which has performed very well ends up not being so good in terms of performance. And this pattern keeps on happening. And what we have noticed is that on an average, the difference between a good performing fund and a not so good performing fund on an average tends to be about 20-25%. This year, that number is 35%. Now, why does this happen? It's quite intuitive. As I said, the canvas in which the multi-cap funds particularly, so at least I can understand when you talk about a large cap category, it has a defined universe of 100 stocks. Here, multi-cap will have to play the entire market. You're talking about almost 500 stocks, and within that, all these variables in terms of market cap, in terms of sector choices, in terms of stock selection, a combination of all of these things could mean that the performance variance can be very, very significant. So you end up picking one fund based on its past performance to be utterly disappointed in the next year, and the cycle keeps on repeating. So picking individual fund in a multi-cap segment especially is treacherous, like what Hansi mentioned. If you have the resources, the wherewithal, you can do that. Fantastic, you can do that. But in multi-cap category, you will have to be very, very careful. The risk reward is on the higher side. So that's precisely what we are trying to address here. What this fund will simply do is it will invest into the ETFs and index funds of Nippon India Mutual Fund. So that's the passive side. So therefore, stock selection and sector bias, sector choices, that is completely ruled out. This is market-based investing. Then the next question is, how much should I invest into large cap, mid cap and small cap? Either you can make constant allocation, you can say I'll invest 1/3, 1/3, 1/3, or have some complicated algo. And by the way, Hansi, you said we are trying to build some complicated algo. That's not the case. We have in fact kept it simple. At the same time, we think that it's very powerful. What do we simply do? We just go and make allocation as per the industry average allocation towards each of these parts of the market. Now, what do I mean by that? Suppose there are 30 funds in the multi-cap category. What is the average exposure to large cap? What is it to mid cap? What is it to small cap? We will just go and simply replicate that. This number will be given to us by CRISIL on a monthly basis. We just go and invest as per that. Now the next question is, why should I do this, right? Why should I follow this kind of a strategy? Is also basis our study that we have noticed historically with the help of hindsight, we have realized that the industry as a whole, and I'm not talking about individual funds, the industry as a whole has possibly got this right. For example, I'll just give you two numbers here. 2014, we know with hindsight that was a time that mid caps and small caps did very well. So at that point in time, this particular category had 40% exposure to mid and small cap, 60% to large cap. However, in the last 2 years, that is 2018 and 2019, we know again with hindsight that large caps did very well. Industry was 75% in large cap, 25% in mid and small cap. So we have noticed this kind of variation happening at the industry level, which also has added alpha to a normal multi-cap investing. The industry wisdom seemed to have added a reasonable amount of alpha. We simply try and leverage on that. So the product is very, very simple. You invest across market cap, large cap, mid cap, small cap. But how much into large cap, mid cap and small cap will be simply determined by not complicated algos, by going and capturing the industry wisdom. And the underlying is passive investing. So no sector or stock bias which can come through for individual funds in this category.
Interesting. Thank you very much for that, Arun. So may I remind you that this is being recorded and you've just shot yourself in the foot, because you've basically said the dispersion between the best performing and the worst performing funds is huge, over 30%. So when Nippon is selling their active funds, play them back this video and tell them you can't go active, okay? So jokes aside, interesting concept, basically saying wisdom of crowds. In the 25 years odd research that I've been, on the 25 odd years that I've been in the research industry, we found that when fund managers allocate on a top-down basis, on a macro sort of basis first and then sector and then stock, whether they're picking regions, whether they're picking countries, whether they're picking sectors, by and large they get it wrong because they get fewer levers to pull. But when they do it on a bottom-up basis, so when they start with stock selection first, that's when they're able to add value, by and large, okay, on average. So it's interesting that you say that you're taking the wisdom of crowds because you're indifferent to whether they're doing top-down or whether they're doing bottom-up. That has the advantage that you're getting the benefit of the outcome of what they're saying without you having to do top-down allocation. So if fund managers whose full-time job it is to look at macro and sector and politics and geopolitics and everything else, if they can't get the mid-cap, small-cap, large-cap allocation right, then I don't think financial advisors or private bankers or even PMS managers can get it right. So I think from that perspective, I agree with you that this is a smarter way to get the collective wisdom of the crowds without you having to do something that research shows is very, very difficult to do. Okay, cool. Second question is, in your back testing, you, I think, do it on a yearly basis. So you're taking, I think, in calendar year, right? Is it, so if you've taken what the manager's allocation was on a calendar year basis, but you're saying going forward, you'll be doing it on a monthly basis. So I'm curious, how much of an extra return do you expect to get? And is that worthwhile? And I guess because another way to say collective wisdom or wisdom of crowds is simply market cap, right? Which is basically, why don't I just buy the BSE or NSE 500 on a market cap basis, which is one fund or one ETF, and it has all large cap, mid cap, small cap, and be done with it. So this is trying to add alpha through the sector allocation, but how much extra return should I as an investor expect?
Yeah, Hansi, before I respond to that question, I would like to start with the comment like shooting on the foot. So this is not a proposition that we are saying is the superior and there is no case for active fund investing at all. The only limited point I'm making here is that individual active funds, especially when it comes to multi-cap funds, will be high on risk return. The returns can be very high, so can be the risk. The chances of outperformance and underperformance can be significant. Whereas by doing this, where we are taking out the individual fund manager bias in terms of stock picking or sector bias, as well as doing this market cap allocation at a collective industry wisdom, we are averaging out, it is this glorious average. So that may smoothen out your multi-cap investing. So I would say that on risk return, active funds will be several notches higher, whereas this would be relatively on the lower side. But again, like what Hansi started with, end of the day, it's equity investing. Second, it's multi-cap investing, which means that you're investing in large cap, mid cap, and small cap. So on a standalone basis, the risk return is high. So that's the point that you need to keep in mind. As I said, we have done this back testing to see historically how things have panned out. In fact, we have done that basis daily NAV. Suppose you have done this and how, so that's how you come to it. So while we presenting the data, it could be for the sake of convenience, we'll show how things have panned. I took an example of 2014 and how things were in 2018. That is to broadly convey what's happening. But otherwise, the idea when we do backtesting will be on a daily NAV and how things have changed over a period of time. So what we noticed is in the last decade, over the last 10 years, there has been some flexibility, about 10 to 12, 15% over 10 years. So I do not expect that on a month-on-month basis, this allocation towards large cap, mid cap, and small cap will vary significantly. But I do expect that over a period of time, when I'm saying over a period of time, let's say there are regime shifts, for example, between 2018-19 to now, and maybe let's say mid caps and small caps start doing well. The hope is that at least based on backtesting result, that the industry would be able to capture that relatively better than individuals can or a particular fund manager can, and that in the past has resulted in reasonable alpha. I do not want to name the number, nor do I want to indicate anything as to what is possible, but we do believe that that can add some bit of alpha, and that is the limited active part as far as this proposition is concerned. Otherwise, the concept is very simple, a fund of fund investing into underlying ETF stroke index funds, which are passives.
Okay, I am not going to let you chicken out. I want cold, hard numbers. Okay, we're finance people. So okay, let's talk forecast. Okay, so we can talk in ranges. So if we're talking about GDP of say 7-8%, inflation of 4-5%, we're looking at equities, broad market equities at 10-12%. And if you're looking at mid to small cap, adding an extra 2-3% in terms of extra risk, you're looking at say what, 14-15% beta. Okay, so you're saying you should be able to add some alpha based on manager's wisdom. So give me a ballpark figure. Like I said, range will do, but give me some numbers in terms of extra return, because your fees, which we'll come to next, is obviously preset. So what is the extra alpha I can expect?
Okay, so I'll start with the disclaimer that past performance is not indication of future returns. These are purely based on how things had happened in the past, based on our backtested results. So in the past, like for example, in the last 10 years, on a 3-year rolling rate return basis, BSE 500, if you can consider that as a benchmark for a broader index, that's given almost about 12% compounded. Whereas this strategy, had you done proper multi-cap investing across market cap and in a way also varied your allocation towards large cap, mid cap and small cap as per the collective industry wisdom, that had given something close to 14.5%. So we are talking about 2.5% alpha based on past. Again, I want to be categorical here. You should not construe that these kind of returns could be possible. Like what Hansi mentioned, there are regime shifts. How things were 10 years back, and the next 5 years, 10 years can be very, very different. But just to, since she wanted me to particularly talk about what had transpired in the past, that's what had happened. Now, she also asked this question that, can we not simply invest into BSE 500? Can you not invest into a index fund of BSE 500? Yes, it may give you an impression that you're investing across the market 500 stocks, but let me tell you, since BSE 500 or NSE 500 are market cap weighted index, today they are 82% towards large cap. I repeat, they are actually 82% large cap. So technically investing into BSE 500 index fund is almost similar to investing into a large cap fund and not a multi-cap strategy. So therefore, this particular strategy, while it is benchmarked to BSE 500 because that's generally the benchmark for multi-caps, but in terms of risk return, it will be very different from BSE 500.
Okay, well, thank you. I agree with you. So usually, large cap comprises about 70 odd % anyway, and right now you're saying it's even higher. And I agree with you also that when markets recover, small cap, mid cap do better, and that's very hard to do on a top-down basis. So I guess being invested in them is a good idea, and maybe this strategy would work. Totally understand. Now, question is, what is it going to cost me? So can you talk us through which particular funds of Nippon are you investing in? What is the underlying cost of those ETFs? And therefore, what is the total expense ratio, including both layers?
Sure. So this fund, the fund of fund, will invest into Nifty 100 ETF. That's a large cap portion, the top 100 stocks. It will also invest into Nifty 150 ETF. That's the next 150. That's the mid cap component. And it will also invest into the 250 small cap index fund, the 250, right? So 100, 150, 250, another 250. So you're talking about 500 stocks. All these are mutually exclusive. So you're investing across 500 stocks. Of course, how much to each parts of the market, each of these funds is going to be determined as we just discussed recently, right? So each of these underlying each of these underlying ETF stroke index funds are low cost anyway. We expect the expenses of these underlying funds to be around 30-32 basis point, right? Which means that the direct plan of this particular fund will have roughly about 30-32. This fund itself will have about 60 to 65. So total expense in the regular plan will be about 1%. So in that sense, active funds typically come for about 2%, 2.1, roundabout there. The regular plan is expected to be about 1%, and the direct plan is expected to be about 30-35 basis point. So broadly, that's the expenses we are talking about.
That's including both layers, right? Just to clarify.
That's right.
I believe the BSE 500 ETF is about 28 bips or so. So this is about 5 to 7 bips more than that. Is that right?
Yeah, just to clarify that. So ETFs, they don't have direct, regular. So if it was 28, 30, you go and do that. Whereas here, if you opt for the direct plan, we're talking about similar expense. In the regular plan, it's going to be about 1%.
So the 1% is I know it relative to active, it's obviously cheaper, but given that this is a passive strategy with relatively quant sort of approach to the three segments, isn't that high? And now, I guess especially in the context of that most retail investors will also pay an advisor a fee. Would you say, obviously you're offering it, but I'm sort of curious, would you still think it's a good fee for the extra return that we're getting?
I think so. Like the way explained, the construct of the product is not completely passive. There is this allocation that we do based on the industry average wisdom, which may not be possible to be replicated by investors at their end. So if you try to do that yourself, maybe you start by one third, or whatever proportion, and then over a period of time, depending on how markets perform, these allocations will keep changing. You will have to rebalance. There are taxation implications when it comes to that. Whereas this is a simple proposition which combines all of these things, and by capturing on the industry wisdom, as I mentioned, there is a bit of alpha also coming through, and all of this, while when you compare to a pure ETF, the expense looks slightly on the higher side, especially in the regular plan. But on the other hand, when you compare to active multi-cap funds, the expense is lower. That's number one. At the same time, there is some bit of value addition also happening to you. Overall, while expense is one part, the more important part that you need to consider would be the risk return profile that this proposition brings to the table vis-a-vis that of any other comparable proposition. I think that should be the starting point. I think that is the biggest USP as far as this product proposition is concerned.
I agree. I mean, if I were to classify funds, at Mercer we used to do that, we would call them enhanced index, which is index plus sort of 0.5 or so. We would have low alpha funds, which would be index plus up to 2%, and then we would have high alpha funds, which would be 2 to 5%, and then would be like high conviction. That would be kind of the spectrum. I would classify this fund as somewhere in the low alpha, which is kind of getting some bit of alpha, but not the stock selection one. Which leads me to another important point is the biggest sort of drags on fund performance are fees, tax, and the cash drag. So let's talk about the two other ones, tax and cash drag. How will this fund be taxed given that it's a fund of fund? And also, while the underlying funds, 2 of the 3 funds are ETFs, and therefore no cash drag, but the third fund would be an index fund, and then also at this fund level you have the cash drag. So explain the impact of both tax and the cash drag.
Yeah, I'll do that. So this fund, the fund of fund will be a completely invested fund at any point in time. So minimum 95% will have to be anyway completely invested. This is as per the scheme information document. So there is not going to be any cash drag from that sense, number one. Second, taxation, you're right, this is a fund of fund. Had it been a fund of fund with all underlying investments only into ETFs, the equity ETFs, the taxation could have been equity. However, since it's also going to be investing into index fund, the small cap portion is going to be in the small cap index fund, the taxation will be that of debt, which means that the debt taxation 3 years and above become long-term capital gains, and less than 3 years become short-term capital gains. Less than 3 years, the short-term capital gains will be taxed as per your income tax slab, and for high net worth individuals that can be very high, 30%, 40%. After 3 years, however, you will get indexation benefit, and at the margin after 3 years, taxation may be very similar to equity. Equity taxation is after 3 years, long-term capital gains in equity is 10%, whereas when it comes to debt is 20%, but you get indexation benefit. So at the margin, they may be similar, or sometimes debt taxation could also be better than equity. But this is something that investors need to clearly keep in mind. This is not a fund we would recommend anyone to come in with a trading perspective, in the sense that you come with 6 months, make money. The taxation is something that you need to keep in mind. Like what Hansi started with, first and foremost is the equity proposition, second multicap. So from all that perspective, it's actually on absolute basis high on risk return. Taxation comes later. So it has to be viewed fundamentally for at least 3 years, if not more.
Okay, so as you said and reminded that this is not, equities generally is not something that you should go in with a short term in mind. You should not just 3 years, we consider 5 to 7 years as a minimum. So I'd say see this as a multi-decade thing. See this for your long-term investment portfolio. This is not the allocation that you have fun with. This is what you build long-term wealth with. In fact, on that note, I would say that it's a thing that people want their investing to be interesting or fun. But as a lot of people have said, I think Warren Buffett, Charlie Munger, and my absolute favorite writer, Morgan Housel, recently as well. If you think investing if you complain about investing being boring, then you're doing something wrong. So this is actually a very boring fund, investing in long-term equities. So yeah, I can kind of relate to it. Now, question is how much of your portfolio should be in this? As I started with, I think you should just get started with a Nifty 50. It's the simplest product to understand, provided you have a demat account. So a lot of my friends who don't have demat accounts and ask me, how do I get started? I think this is probably a decent fund, given that it's giving you exposure to that. Do you have any views on that, Arun, on portfolio construction, given that you're obviously a fund manager as well?
Yeah, so you took names of Charlie Munger and Morgan Housel. I'll give you a local example, which will summarize the concept very well, and that's what at least we will do in this particular fund. It's not celebrity endorsement. So Lord Hanuman, when he was asked to bring the Sanjeevani plant, right, it has a lot of benefits, but he did not know which was the Sanjeevani plant. That's pretty much similar to a multicap, picking up a multicap fund. So individually they could be brilliant, but you don't know which one. So Lord Hanuman actually brought the entire mountain. So in a way, this concept is that you're getting the entire market. The Sanjeevani could be there, but that's there within the mountain. So that's broadly the product construct.
I agree with you, but I think technically the mountain then would be the BSE 500. So if I absolutely want to pick up the mountain without any sort of shortlisting of which herb looks like the Sanjeevani, then I would just buy the BSE 500. So in a way, I see this as somewhere in between. Like I'm shortlisting, these 5, 6, 7 plants look like Sanjeevani, so let me sort of get the collective wisdom of the fund managers. They might be right, but they might also be wrong. So they might be slightly underperforming the index as well. But given the way you've constructed it, I don't see that risk of underperformance being too high at all. It'll be in the ballpark of the index. So by and large, I'd say it's a low risk, low return alpha type compared to the index fund. So yeah, I think it looks reasonably okay actually. Just FYI, if people do want to build their own, actually as a researcher, let me take a step back. When I look at a product, I always ask for the underlying asset classes can be achieved very, very simply and very, very cheaply, whether it's equities, whether it's bonds, whether it's gold, whether it's whatever. The financial services industry sometimes makes things complicated. I said sometimes. And so then the question therefore to ask is, okay, you are making things complicated in terms of adding alpha, but what am I giving up? What am I paying for it? And this one is actually relatively cheap and relatively low alpha. So I say it's perfectly good to consider. Yeah, I think any other sort of points that you want to make?
Sandeep, you have any questions?
Yeah, I have one last question. I wanted Arun and Hansi both to opine. So we covered the interest of retail investors pretty well. Thank you so much with those exotic examples of Hanuman and Sanjeevani. My question simply is, what about the HNI investors? How should a typical HNI investor look at this fund? How will this help balance the portfolio?
Sure. In my view, HNI segment is one segment which is actually very active in passives. In fact, that's the segment, the high net worth individuals who understand that individual fund management, when it comes to select funds, very high on risk return, and the passives on the other hand offer a very palatable risk return profile, and they are preferring that significantly. So from that sense, this product should also have a very good appeal for them is my assessment. So largely it's passive with some bit of the allocation that we are doing in what we consider is a simple yet a smart way. So I think it should appeal quite well for the HNIs as well. Hansi, what is your view?
I agree with you. I don't think there should be theoretically any difference in the way a retail investor or an HNI investor invests. However, a high net worth individual does have access to advisors who can do more research. So that was the point I was making earlier where I lost my train of thought. high net worth investors, with the help of advisors and research, can replicate something like this through the concepts of ETF baskets or portfolios. And there are quite a few PMS managers and RIAs now actually doing that. And the technology allows them to do that en masse as well. So I think there may well be some HNI investors and their advisors who may have a slightly different thesis of how to invest, do the allocation between large, mid, and small, and also add in maybe international or other ETFs. So I think they can probably replicate it. Having said that, there's nothing wrong with this thesis. I think it comes in a nice, neat package. So if you don't want to have the hassle of going and doing it yourself, then sure, I think this works. So there should be no difference really. And in terms of like I said, the three questions: can it be done? Is it done? And can I do it? No difference in active passive for retail versus HNI. Is it done? Again, no difference. But it's the can they do the research? And also, I guess maybe they probably have more alpha opportunities in the PMS and the AIF space, if not in the mutual fund space. So I'd say that some HNI investors who have come up with their own view and said they want to go passive or have a core passive, for them this is perfectly fine. But if they're able to access managers with low AUMs and alpha potential, then I'm sure they would want to access it. They can. So overall, good.
All right. So thank you, Hansi. Thank you, Arun. An interesting afternoon hour spent very well. The summary is that it's a very good idea. Looks like a very good idea for a retail investor as a core product, part of their portfolio, long-term investing. Fill it, shut it, forget it, kind of a product, because it auto optimizes itself at the end of every month for you. So that's the message coming from the experts. For an HNI investor, you could look at it as an asset allocation product. Again, as a core part of your portfolio. A low cost product which gives you the best of the market wisdom, collective market wisdom, in an active plus passive kind of a structure. The NFO, as I said earlier, closes on the 24th of December. So all the very best. Please do your own evaluation and make the most of this opportunity. Thank you, Hansi, again. Thank you, Arun. Thank you, viewers. Have a very good afternoon. Merry Christmas and a Happy New Year in advance from Nippon India Mutual Fund. Thank you very much.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.